Gold prices rebounded to show a $10 gain for this week so far on Wednesday, shrugging off a raft of hawkish comments on U.S. interest rates from senior Federal Reserve officials, as new data showed bullion demand surging in number one central bank and private sector buyer China, while gold-backed ETF products traded in the West continue to shrink. Gold priced in the US dollar touched $2,044 per troy ounce, reversing the week's earlier drop following hawkish comments from Fed Chair Jerome Powell after the People's Bank of China, number one among the world's central bank gold buyers so far this decade, said it added another 10 tons of bullion to its reserves in January. The 15th consecutive month of reported growth, that took its reported gold holdings, widely thought to understate the true figure, up to 2,245 tons, equal to more than 7 months of global gold mine output. Gross gold demand in China's private sector, meantime, hit a 9-year high above 271 tons last month, withdrawals data from the Shanghai Gold Exchange suggested on Tuesday. In contrast to those SGE flows, gold investment ETF trust funds, over 99% of whose value as a group trades on Western economy stock markets, have now shrunk in all but 3 of the last 21 months as a group. New data from the Mining Industry's World Gold Council said today, needing another 1.5% less in bullion backing last month. That gold ETF outflow equated to more than 5 days of global gold mine output, adding 51 tons to market supply last month, with year-on-year outflows reaching 268 tons as the correlation between gold prices and ETFs snaps. Already shrunk by 1/3 from its COVID crisis peak of September 2020, giant gold-backed ETF, the Spider Gold Trust yesterday, shrank by another 4 tons, down 0.5% with its heaviest one-day liquidation in almost 4 weeks. Only one of the 25 analysts entering this year's LBMA gold price forecast competition mentions Chinese private sector demand as a factor in their prediction, with German refiner Heraeus's precious metals trader Alexander Zumpfer saying that India's robust economic outlook could boost jewelry demand, countering weaker demand in the West and in China. Entrants instead name U.S. interest rates, global central bank buying, geopolitics, and the risk of banking crisis as the biggest drivers of 2024 gold prices. Betting on March's Federal Reserve decision now sees only a 1 in 5 chance that the Fed will make its first U.S. rate cut next month, down from a 90% certainty at the turn of the year. With May becoming a 2 in 3 shot according to interest rate futures tracked by derivatives exchange the CME's FedWatch tool, the cost of borrowing overnight dollars will then end 2024 at 4.16% per annum, market consensus says. That's almost half a point higher from the forecast given by the futures market in mid-January. The Fed itself projected an end 2024 rate of 4.6% in its dot plot forecasts just before Christmas. Despite the worsening fears over commercial real estate debt hitting U.S. banking stocks, more data is needed to confirm inflation has retreated before the Fed can cut rates, said non-voting 2024 member Austin Goolsbee, president of the Chicago Fed, yesterday, a point repeated by non-voting Minneapolis Fed President Neil Kashkari in separate remarks. It would be a mistake to move rates down too soon or too quickly, agreed non-voting Fed member, Bank of Cleveland President Loretta Mester in a speech Tuesday, also striking a hawkish note. But voting member Atlanta Fed President Raphael Bostic says the central bank has refined its definition of maximum employment to mean a jobless rate of 4.1% rather than 4.5% previously, while Patrick Harker of the Philadelphia Fed, not a voting member until 2026, says the U.S. central bank appears to have achieved a soft landing with growth continuing while inflation recedes. Now, with inflation moving closer to our goal, we need to balance the risks to achieving both sides of our dual mandate of maximum employment and 2% inflation when determining the appropriate stance of policy. Today brings another 4 speeches from Fed presidents and governors, +1 on Thursday and Friday again. Back in the bullion market, number 1 silver-backed ETF, the SLV, yesterday saw its first inflow in 2 weeks, expanding by 1.1% as the bullion price slipped close to late January's 2-month lows. Silver in London today reversed a 20-cent overnight drop, trading back at $22.43 per troy ounce. That still left the gold-silver ratio above 91, close to 17-month highs, and a level seen as signaling macroeconomic fear, if not crisis, according to one bullion market strategist. With the stock price of New York Community Bank sinking again, U.S. commercial real estate contagion is now moving to Europe, says a headline at Bloomberg. European commercial real estate, the cracks are starting to show, said a headline at the Financial Times in April last year. Please like this video and subscribe to our channel.